Good morning, good afternoon, good evening, yWhales, wherever you are in the world today. Really an exciting one. So we have a kind of a right at the edge of launching, funded, not yet ready for full deployment. And we're here with Sprace Protocol. I've got my buddy, as always, Mr. Goss, who's traveling the world. And again, I have these amazing backgrounds here, but his is actually real. How you doing today, Mr. Goss?
I'm doing super well, and I'm super excited. I'm in Guadalajara today, so it's nice and warm, unlike Zug. So I'm quite happy to be doing this from a different spot.
We're thrilled with you continuing the crypto tour and making sure that everyone knows that Web3 truly is decentralized. You can, as long as you have a halfway decent internet connection, you can do anything you want in this world.
And you're allowed to do it from wherever, and no one cares. That's pretty nice.
It's preferable too. But let's jump over to the team over here at Sprace Protocol. We have Raghav and Joel, and let's go ahead and start with you, Joel. How did you get here today? What was the path to get you into wanting to have a Web3 protocol like this?
It's interesting because I probably got here differently than a lot of other folks. I'm not a software engineer or anything by background. Raghav has a little bit more of that background. My background is in finance, and investment banking, and then private equity, and then running a niche non-correlated real asset fund. And really, it was my career path has been largely fueled by frustrations that things don't exist that I think should exist. And that was how Raghav and I got together years ago and started running a fund together, solving a problem that we felt didn't have a good solution. And it was over a period of many months, as I started to understand a little bit more about blockchain and what it does and what it can do, that it was kind of an inside joke for a while. We kept saying, oh, we should just put our business on the blockchain. And after a while, I was like, I really think we should put our business model on the blockchain, because what we've developed is really powerful, and I think it would solve some real problems. And I know I haven't explained anything about what that is or what problems we solve, but that was kind of how the conversation came to be, and it was almost an inevitability. Sometimes I compare myself to like a pretty good brick and mortar business owner in like 1994 who's going, I think there's something to this internet thing, and I think my business should maybe be online, but I'm not sure exactly how that looks. And so I've been in the last several months getting people who can help me understand how that looks and what that needs to look like. And Raghav and I have gone, suddenly and way over our heads and learned how to swim a little bit in these deep waters of blockchain and things that are changing every single day, and understanding what Web3 really is and what it can do. And we've just become increasingly convinced that oh wow, this is the world's going to be very, very different, and we want to be on the leading edge of it, not on the trailing edge of it. So I don't know if you have a lot of kind of financier backgrounds, but it's been a path of innovation and trying to solve real world problems and trying to anticipate what's going to be valuable to the world in a year, 2 years, 3 years. And so it's been a lot of fun, and I'm learning a lot, and I'm behind on some things in terms of, I go to blockchain conferences and I understand. The first one I went to, I think I understood 25% of what was being said. The next one, maybe 50%. I go to finance conference and be a keynote speaker. So it's just a whole different world for me.
It's amazing though. And we hear the story quite often from people coming from TradFi and various, kind of traditional finance sources, that once you understand, and once you kind of, you've taken that red pill and you've seen the behind the scenes look at this, how dynamic of a change and how eye-opening it is. How did you, what was your first eye-awakening experience with blockchain technology to the point where you said this is something you want to do full-time and you're willing to go build in a very volatile space?
Yeah, I think there's a couple of things. And look, like most, I think creative innovations are born from a place of frustration. And I would say that for me, it came from a very similar kind of position. When we, like Joel said, we started our investment fund about 3.5, maybe 4 years ago at this point in time. And we went through a process of bringing something and birthing something that was relatively unheard of and new to the world at that point in time. And we understood the complications and effort and problems that people with innovative ideas have, especially when you're trying to raise money that's not from venture capitalists. A lot of what we're trying to do was very much outside of the traditional world, and I think as a part of that journey and part of that process, we just got to the point of realizing that, look, we're onto something. If there's this many calcified thought processes out there where people are just unable to break out of, well, this is how it's always been done. You go to a bank. Well, no, this is how it's always been done. You go to a lender. Oh, what do you mean you don't take, there's only equity and debt. There's nothing else. And so that itself was a telling point for us about 3.5 years ago. I was a more reluctant one in this relationship in terms of moving to the blockchain, to be perfectly honest. I think 3-4 years ago, there was still a lot of skepticism about this space. Not that it's completely cleared up now, but there's a little bit of a, especially for people who come from not from the blockchain world and maybe some tech background, and even within the tech world, there's still a lot of skepticism around: is it real? Can it be regulated away with a snap of somebody's fingers? And so I was a little more reluctant, but I think inevitably we just saw the writing on the wall. The macro trends were there, the geopolitical trends were there, and leaving all that aside, from where our business was, we just saw a unique opportunity which just had not been done. And our process began, I would say, what would you say, more than a year ago, about 2 years ago, where we started researching, talking to people, trying to understand how we would do what we were doing and do it in a way that's effective and actually makes sense to the blockchain world. And here we are today. I guess it's been a learning process over the last couple of years, but we're coming up the curve rapidly, and I think everyone's heard this, but if you're out of the ecosystem for even a couple of months, you might as well just start over from scratch. So there's a daily learning process, which I think and both Joel and I are lifelong learners. I've switched what I do maybe a half a dozen times. So learning and coming up to speed on something new is not a unique experience for either of us.
And Raghav, you're a startup guy, correct? Like you've been doing this for a while.
I've been doing a couple of different startups. I started off very traditionally as a consultant, and then kind of moved over to early stage companies. The first time I heard of Bitcoin was 2008. I was in grad school then, and a really good friend of mine who's a venture capitalist now was yelling about it and screaming about it up and down the halls of B school, and I was like, yeah, he's crazy. Let's not touch that with a 10-foot pole. but and this was at the genesis of Bitcoin, and then so I did own some Bitcoin back then, and conveniently have forgotten the key phrases and lost whatever I had back then. But that's how it goes. And since then, and after that, did the startup thing at Groupon. Went to another early stage company that was in the digital marketing space, and then another early stage company that was in the real asset revenue generating space. So for me, it's all about finding those little niches, finding those areas which no one thinks about in an obvious way, and figuring out how we could do something there that's unique and well positioned.
Awesome. Great history. So let's go ahead and jump right into tackling Space Protocol. And who wants to give the elevator pitch on what this is, why it exists, and why we all need to go utilize it?
I'll give. Raghav and I both approach things very differently, which is helpful because we always bounce everything back and forth. It's even, our personalities and our outlooks are very different. With the joke, but it's actually true, is I'm an endurance runner and he's a tennis player. And so he's kind of, where's the ball? What do we have to do? And I'm kind of going, we're going this way. And so in order to understand what we're doing, I have to give a really quick background on what we've been doing, because what we're doing is we're bringing something that we've been doing to a new and better place. What we've been doing is solving a major problem in finance, which has to do with real assets. And we had we made the creative switch years ago saying, look, assets are always financed on credit, and that's extremely limiting. And it's the wrong way to look at them, because then they're always treated like depreciating liabilities, when the reality is they're the thing that enables all the revenue. When we say real assets, we just mean hardware. Hard assets that are the centers through which business is done so that revenue can be generated. And that's a very, very broad universe. And we actually created the first ever institutional fund. And we have institutional investors, including publicly traded funds. So we come from a very institutional space. And so we're used to being audited and understanding the complexities and the regulations and all that sort of thing. That's our life. But what we solved was, I'll go back. We created the first ever institutional fund that all it does is buy real assets and gets a share of the revenue that they generate. And that unleashes so much value in businesses because it removes the CapEx from the conversation. It's equivalent to the switch of software becoming SaaS, where it suddenly fits into an operating budget instead of a capital budget, and boom, it can do anything now because it can fit into any facet of the enterprise. Well, nobody had made that switch for hardware. It was largely limited by the financing structure. So we created a financing structure, and we actually have a couple of patents pending around some pieces of it because we couldn't believe that nobody had done this. And then looking at it more and more, we determined that, these real asset pools that we have do a couple of things. They create very stable, high yield, uncorrelated revenue, and they store value very effectively. And I was looking at the world going, I think value storage is going to be a big deal because right now, if you want to store value somewhere, you're very limited. It's either in the traditional central banking system, or you buy a Picasso, or maybe some gold, and that's kind of it. We said, no, we've got these machines that these pools of real assets with revenues attached to them, and those revenues are non-correlated and they're not attached to market prices, and they kind of just mushroom over time. What if this could back an actual protocol? And what if we could create a marketplace where real asset owners could get the liquidity that they need, that we know that they need, and people who are trying to store value can participate in that value storage pool by way of the revenues over time. So that's very vaguely what we've built, and what we're building is we've fully architected a protocol that enables that to happen. And I'll be quiet there because I know Raghav has his take on it as well, but that's how I think about it.
Very cool.
Hey, before we do that, quick question. Can you give us some examples? Like, I'd love to have some examples of these type of deals because I think that'll be super, super easier to understand that way.
Sure. Yeah. How about I'll give a legacy example of what we've been doing, and then Raghav, if you want to give the example of how it would look on the protocol, since we were talking about that this morning. Is that good with you?
Yeah, go for it.
So what we've been doing is we've been coming alongside a business owner. Let's give an example of a track and trace IoT company. So they've got a logistics platform where they're saying, hey, Mr. Large Enterprise, we can tell you where all your stuff is all the time. Great. And they're solving an operating problem. They're optimizing operations. And so they're talking to an operations manager at a company that's bigger than they are, saying, hey, with our software, we've got this dashboard. We can tell you this and that, and we can save you 10%. Fantastic. Okay, we just need you to buy $750,000 worth of these sensors so that we can deploy them. And that's where it all comes to a screeching halt. And the ops manager goes, I don't really have a CapEx budget. I don't want to buy $750,000 of your nifty widgets. I want the software, though. Is there any way we can put those together? And the business owner to date is saying, I can't just eat that on my balance sheet, even though I know that I'll make a lot more money in the long run if I could. And there was really no mechanism to do that. So we were the fund that would come behind that tech company and say, don't ever sell your assets to anybody. We'll buy all of them, bake it into your recurring revenues, and we'll participate in that. And so we get the benefit. So all we are is a balance sheet as a service. We're the balance sheet where the hardware lives, and we get the revenue participation. And over time, we make a very nice return on owning those. And that enables that business owner to get out of the business of selling hardware, be in the business of solving a problem. It shifts box selling revenue into recurring revenue. Their valuation goes up, and their customer acquisition cost goes down, and their lifetime value increases. So it's a really powerful thing. So we'd say, okay, if your valuation goes from here to here, and our cost of capital fits inside that, you should do the deal. And that's what we've been doing, and we're approaching about 100 million under management, and we've done that, rinsed and repeated it a dozen times. So that's kind of the legacy-wise what we've been doing, and we started it because we couldn't believe that nobody was doing that.
I love the inside baseball of this. I mean, it is, you guys are so ingrained, and it's such you have to know that this even exists. Otherwise, everyone's kind of just walking right by anything like this. And it, again, makes perfect sense. And absolutely.
That's a theme. There's a big theme in what we do of everybody assumes that problem's already been solved, but we keep finding the frustration that it turns out it hasn't really. Everybody assumes a bank will lend for hardware against revenue. They won't. They don't. They never have, and they never will. And so there's there's a lot of assumptions in finance, and I think in decentralized finance, assuming that, oh, somebody's already thought of that, or there's already a way to do that, when the world's changing very, very fast. And the reality is the innovation in finance really hasn't kept up in any way.
I mean, the interesting thing is, I think when we started, we didn't fully appreciate how big this problem was. And I think that's something that's worth mentioning. When we started, we thought, look, this is maybe a couple of $1 billion problem, and we can probably, build towards that goal. The reality is, and this is just U.S. facts and data alone, there's $1 trillion worth of hardware bought and sold in the U.S. on an annual basis, right? So, and when you think of the definition of hardware is any hard asset. It could be an airplane. It could be an IoT sensor that goes in the back of a truck. It could be servers sitting in a data center wherever in Omaha, right? So there's literally very little that we don't consider hardware, quote unquote. And I think the most important thing is that once we start looking at the universe from the lens of, does that physical thing enable revenue, or is it critical to the revenue generation, then what we do starts to just open up more and more doors in terms of how we think about the application of where our solution fits. So I mean, look, and Joel's right. And we've had to learn that there's stuff that's sexy in the blockchain world and stuff that's not. A lot of what we do in the traditional world is not sexy, right? I mean, this is not stuff that people think about. People don't think about where their Dell Blade servers are sitting, and if they're doing anything of value apart from depreciating on a rack, right? So I think for us, part of the education has been how do we position things that kind of see that initial spurt in growth and adoption on in the DeFi world and are interesting to people in the DeFi world. So so we could even just use Joel's example, or I can give another one in terms of how we see these real. So let me give the one sentence, like what we're trying to do with the protocol, and that'll give you a sense of the different applications for it. So we believe we're the first blockchain application that enables DeFi yield generation that's backed by real world assets and their revenue streams. I mean, that's basically it.
Okay.
Everything that you see out there today, the majority of the projects that are quote unquote real world asset backed are just centralized, or it's essentially a pure play crowdfunding type of scenario, right? And we've seen a lot of these with, I think even the Ritz-Carlton tried to launch a hotel and fractionalize a sale of the unit, essentially taking a fractional ownership model and putting it on the blockchain. And these are they're interesting, but they're all very centralized ways of doing it. And there is no, and from what we've seen, there is no Web3 protocol that's actually backed by real asset revenue. And so our goal is to democratize this marketplace. And so essentially give asset owners that have revenue coming off their assets a way to monetize that today, as opposed to waiting for future revenue streams. And on the other side, give token holders or users that store of value that's backed by real world revenue streams, and do it in a way that's fully decentralized. So that's like the gist of what we're doing here. So I mean, so simple example, again, this is not our sexy MVP or initial use case, but we'll talk it through with you guys so you guys can get a sense of how someone can use it, right? So imagine you're a small business owner that has a fleet of maintenance trucks that goes around town servicing vehicles. Business is good. You've got a fairly predictable revenue stream off of each vehicle. One vehicle equals X amount of dollars on a monthly basis. Great. So what you would do is, if you want to grow your business today, is if you approach a bank, then you've got the age-old problem like Joel was describing of, how do I get more credit to go buy a new Mercedes Sprinter van or whatever it is in order to keep growing my business? Oh, well, I can't. I got to build my balance sheet, wait 6 months for the cash flows to come in, save it off, and then maybe in 6 months, if I go back to the bank, they'll see if my balance sheet's healthy enough and they'll give me a loan to expand.
God forbid that vehicle is customized in any way for your business, because then nobody will finance it.
Yep. So this is just one simple use case, and we've done some work in the traditional space in this already, so we know this space well. What this business owner could do then is essentially come to the protocol, show the protocol exactly what they've done in terms of their historical performance, and pledge future revenues or share future revenues to the protocol, and essentially make monthly deposits, monthly transfers into the protocol. And on the other side, we've got liquidity providers who will essentially buy a part of that future revenue stream and get yield for it. That's it, right? Now, how we do that and do it in a way that's essentially fractionalized NFTs that have utility value, that allow that to happen, is kind of the secret sauce that goes behind how we bring this together. But that's in a nutshell what we're trying to do. So the value prop is, as a small, in this example, as a small business owner, you're no longer constrained by traditional finance. You can actually access a market that historically you would never have been able to access, and get liquidity from future value to cash flows today to grow your business at a rate that competitors who haven't thought of going this route can't. So I'll pause there.
I have so many questions.
Of course.
Let's start with the big one. How is this regulation? How are you guys regulating this, and what does this fall under? Because it sounds like you're creating a security.
Well, that's a really good point. And keep in mind, regulation is very much in our DNA in terms of understanding where we are. Because we're in a very regulated space, and we created an asset class that had no formal definition prior. And we had to create the entire legal ecosystem around that from scratch. And we've spent
hence why I'm so excited to hear
SEC attorneys. And we talk to attorneys literally every single day, and have for years and years, because we've had to go through all of, like, even in our traditional fund, what is it? Is it a security? And the answer is no. We actually don't have I used to have all the securities licenses, and none of it applies. So it turns out that when you focus on revenue, and there are more answers to this, but I just want to put this in the back of your mind. Revenue is its own beast, because when you have a revenue share or a royalty type stream, and you haven't lent anybody any money because all you did was collateralize something, then you fall into a really interesting gray space. For example, we've spent in our legacy business, we've had the pleasure of having 20 E&Y associates, Ernst & Young associates, on the other side, because they're trying to figure out how to audit, one of our major investors, and they can't figure out what we are, because we don't fit into any given box. And we think that's a strength. And now that's hard in the institutional world. It's very hard to raise money on going into a hedge fund and saying, here's something you've never seen before and don't know how to classify. Will you please give us tens of millions of dollars? And most of them say, we can't. We literally don't know how to allocate to that because it doesn't fit anywhere. But we sure do like your return profile. And every now and then we find one that we say can put on a cowboy hat and say, you know what, let's find a way to actually do this. And that's been our entire investor base to date, is those exceptional type ones. So you're absolutely right, Jay, that there is the regulatory world is not sure what to do with these kinds of things. All we can do on our side is do the very best we can to be as compliant as we can and follow the rules, knowing that they may change a rule at some point, and they may change a rule that affects our legacy business at some point. So far, so good. So far, we know our auditors ultimately understand. Sometimes they come to differing opinions, but they can all get to grips with everything we're doing works and makes sense. It's just hard to fit it into legacy systems.
Yeah. So so to get a little more specific, right? So the NFTs that represent the future value of revenue that we're getting from that the asset owner is getting from their asset being deployed really is a utility token that gives token holders the ability to vote on what types of assets are coming in, what type of liquidity is sent out, and really it's all handled through a DAO. It's a utility model, and B, decentralized, where there's no single person making a decision on, we want this asset, we don't want this asset. We believe that this much, this asset's future revenue streams are worth X, and therefore we're going to pay out 30% of X to the asset owner at any given point in time. So the goals for us, we're facilitating that marketplace and doing it in a way that's through a DAO that we don't actually have any control over. There's some early initial verification layers in terms of, hey, are you actually, is your revenue stream really that good? Like, for an asset owner putting their assets on the platform. So there's some validation layers and verification layers.
Fortunately, that's what we've been doing for years, and we know how to kick it off the right direction.
Yeah, and a lot of that is it's rules based, it's algorithmic. It's not, and this is partly where some of the patent stuff that we have. I mean, it's a third party type of endeavor there. So we believe, and of course, look, the SEC is going after fractionalized NFT situations where I believe most of that's really more Ponzi-like, unsubstantiated models that don't really have anything backing their staking farming rewards that are coming out of there. So I think we're kind of staying away from that space completely in terms of how the NFTs, the fractionalized NFTs, will actually be used within our protocol.
So I'm curious, is the asset owned by the protocol and you effectively rent it to the owner, or do you finance it for them? Like, what's the actual legal structure of who owns the asset?
Yeah, the asset owner, I mean, so it can vary, right? In some situations, in most situations, the asset owner owns the asset or has legal rights over the asset, right? And so for us, really, it's a question of, are we enabling them to buy the next asset, the next truck, the next whatever, in order to keep growing their business? And obviously we'll have to have bad actor safeguards and all the other stuff, which we're going through the process of designing to make sure we're not, losing people's money that are coming through the protocol. But the whole thing is it's all algorithmic and rules based. So there's minimal intervention to do there. So the contract is literally a binding contract that me as an asset owner who has revenue coming from my assets will be submitting X amount of this revenue on a monthly basis, quarterly basis, daily basis, whatever it is, into the treasury of the protocol, and then the token holders will have essentially have rights to that treasury, and then be able to vote on how that treasury decides what to do with those funds. There's obviously some opportunities because we're building a true treasury, which is actually backed by USDC, USDT, whatever stablecoin assets we have as well, which are then able to be farmed, and that's a separate topic. But there's other things you could do once you have that treasury and that base built up within DeFi. But really, the function would be, what assets do we want to be a part of this treasury? And then, theoretically, no one should ever want to redeem their tokens, because the value of that token is always more in the future as the asset pool keeps growing. And if you do want to redeem it, then you get today's value for what that token is, not the future revenues that token is theoretically going to see. So that's how we think about that.
So real quick on that. So the tokens are they in the wild? Are they able to be on any DEX, or is it only internal to a centralized kind of exchange that you guys are running?
No, it's a DEX launch. Yeah,
okay.
It's not going to be centralized. Yeah, it's a DEX launch, and we've there's the goal is to rebase. So duplex rebasing. So there's two layers of tokens, one at the asset pool level, and we're working through some of this logic right now where do we tie it at an asset level, or do we tie similar assets, vehicle asset pool, real estate asset pool, some other. There's different layers of aggregation and different layers of pooling we could do that allow counterparties on the other side to say, oh, look, vehicles look interesting. Oh, no, I only want the Porsche rental sub asset pool, right? So there's some level of what will work in the marketplace and how do we position it. But the idea is like it's completely transparent. And then based on the actual revenue streams being pushed into the protocol, that rebases on a daily basis. So, hey, I was supposed to give you $100 today. I gave you 101. Great. That yield number ticks up. I was supposed to give you 100. I gave you 98. It ticks down. So an asset, a user on the other side can very, very clearly see what's happening with that asset pool or asset and make a decision on what they want to do with that holding that they have.
And I've always had the vision that it gets really, really interesting when you have that secondary token layer that's the aggregate of all the underlying assets, because that's where you have that really potent store of value saying, I'm holding a digital asset token that is backed by everything, where there's a whole lot of things that have to go wrong before there's nothing behind my currency. And I think that's going to be a really important part of the narrative going forward, is to have a scaling, to be able to really store value at scale in a transparent way that has real value behind it, and the value that's actually growing over time, not shrinking over time, and isn't relying on other people participating in order for you to keep getting your payout and yield. It's actually an organically stable value storage. And I think when you aggregate that and start thinking in the terms of, as we've seen, like there's a whole lot of assets out there that need this kind of solution. And if you get, even if you just had 10 different profiles of them, which is about what we run right now, then a lot of stuff has to go wrong before you're not seeing the storage and the value and the yield and the performance that you really wanted to see.
So what phase are you guys at right now of your roadmap?
We have designed and architected. We have all the legal entities in place and operating, and we set it up very carefully where the DAO is separate from the treasury, which is separate from the design. And so we've set it up as decentralized as we can, and in a way that can really scale that way. And that there was a lot of thought that went into that, even the jurisdictions of where we were and where we are with those. So the legal entities are set up. The front end functionality of the token functions. You can go to spaceprotocol.io and buy token, and that, you know, that does move into our treasury. We do, and we get that that value immediately. So that functionality is there, and we also have fully architected what the backend protocol should look like to get to MVP. Now we're just starting to actually code it with our developers. That's kind of where we're at. I don't know what you call that stage, but that's where we are.
We're starting dev. We expect launch mid Q2, so 2.5 months, 3 months out from now is when we'll have the MVP on the up and running. We expect there'll be obviously iterations as we evolve how the treasury works and a couple of those things. We've there's a couple of, as a part of what we're doing, there's really like three, I guess. Partly, if you leave aside the Web3 decentralized approach that we've taken, there's two more fairly interesting things that we've had to develop in our architecture. One is a new EIP, Ethereum Improvement Protocol, because there is, believe it or not, there is, and we didn't realize this was the case, but there is no EIP out there that allows us to do what we're doing, and so we've essentially had to design our own in order to make this work. And really, it's it'll use part of the EIP 1155 standard, and then additional logic for the asset token logic, mapping assets to the asset level tokens, and then some duplex rebasing that we need to do. So that's going to fit in within our new EIP standard, EIP 1543. So that's I guess one fairly significant innovation that's come as a result of our design and architecture. And the second is, look, we intend on using IPFS as a storage layer on our side. So obviously, taking the benefit of the Filecoin protocol as much as we can to enable this. So there's a little bit of there's a lot of thought and nuance that's gone into how we've architected it. Dev starting, I think our learning curve is now on what's the first sexy asset to bring on the protocol, right? I think are people going to be excited about IoT hardware that's sitting in the back of a truck somewhere? I don't know. We'll need to have more discussions around that. But the good news is, right, we have existing relationships and we have these existing businesses that we already work with, where this is just a natural fit. So we have access to, 40, 50, $60 million worth of assets that we can bring onto the protocol on day one. So it's not like we're sitting around waiting. We can be our own guinea pig, and then not only and then very rapidly as we see different verticals that we want to go after. Maybe it's real estate, maybe it's something else. We have those networks established already. Just bring people on, and build the total value locked in the protocol from day one in a pretty fast way, and then increase adoption from there.
Hey, yeah, I was going to ask. So you're saying you're doing an EIP. Are you building this on ETH, and you're actually getting an EIP deployed to ETH, or are you doing an ETH fork and you did a change to that?
No, it's on ETH, and then it's on ETH. So
interesting. So when is your EIP going live?
TBD. We'll let you know as soon as we're kind of in the midst of that planning process right now. So we'll have at least the documentation should be within the within the month, and then we should see functionality like rapidly after that.
And how hard is it to get an EIP adopted by Ethereum? I've never had that problem.
We'll let you know.
Fair enough. Okay.
Yeah, we'll let you know. We're in that process, right? We're actively writing that out. We're working on that right now. So I don't have a good answer for that.
It's real. Yeah. We interview a lot of teams, and you're the first one going after your own EIP. Normally it's like just, add a couple more smart contracts on top of it to figure it out. So what was the reasoning, to do it that way versus again, just adding on a couple existing ones?
It's actually
smart contracts.
They don't. I mean, the short answer is there's nothing there that solves. I mean, that we'll use existing ones, but there's nothing there that purely solves for what we're trying to do. I mean, so early on, we actually had this discussion around, should we be a layer one? I mean, that was kind of like where we started, and we're like, that's a lot of work and a lot of different types of problems. And so, okay, look, let's not do that right now. Let's maintain the optionality for us to get there. We can always build bridges to whatever we need to, Solana, wherever we need to go, we can go. So I think we start, but then as we got into it, we realized that there's certain contract logic that just doesn't exist that we're going to have to do from scratch. And that's kind of the the genesis for the new EIP.
There's also, it's important to us, and kind of goes back to our DNA of designing the way something really needs to look in order to scale, instead of just taking existing things and bolting them together and saying it'll be fine and we'll solve that when we get there. Well, that's fine at very, very early stages, but when you start putting millions and millions and millions of dollars worth of pressure on things, you tend to find cracks. So we take that first approach of, let's engineer it where it's engineered correctly without over engineering it, to actually do the functionality that we need to do. And, obviously going into it, we had no idea that that there was going to have to be some new protocol design. But with our,
we weren't happy about it.
It made sense, and said, okay, this is actually the right answer. So it's always walking that line between, you don't want to rebuild everything that's already been built, but sometimes the stuff that's there doesn't necessarily fit, and you cause more problems than you solve if you don't use the correct engineering.
So talk to us a little about your team, tech team. Are you guys centralized, decentralized? Who's working on this one with you guys?
Yeah, we've got it's a decentralized team. It's literally across multiple different time zones and continents at this point in time. Joel and I just happen to be in Colorado because that's where we live. We've got teams that are part of our team is in the East Coast, New York, Pennsylvania, and then part of our team is in unfortunately conflict-torn parts of the world right now. So we're luckily they're all safe, and for the most part in places where they've been able to keep themselves safe. So we're working through that. We have other parts of our team that's based in India as well for some of the other smaller bits and pieces that we're trying to get together. So from a design and architecture perspective, it's Poland, Ukraine, Russia, Belarus, US, India, and then I don't think we had a discussion with a few folks in I'm forgetting. Yeah, so that's generally where we are right now. It's decentralized tech design and arc.
And we've worked with we're specifically working with people who have worked on projects that we know and respect, and who were involved in some of those developments, and who have seen the mistakes and the problems, and we had a lot of conversations on how would you design X, Y, or Z differently, and how do we make sure we don't run into that. And so it's been we've had the great unfair advantage of having very experienced designers, both just from a general architecture side and then from a dev side as well.
So we're in a very early phase of this asset class, is my opinion, and it may or may not be true, but very early. And I think what you guys are tackling is a real problem, and I actually believe that you guys have a legitimate solution to it. Do you believe that we're there yet for people to understand? Like, the adoption rate is so small for blockchain. Do you feel that the target market that would utilize this is ready for cryptocurrency blockchain adoption, and vice versa? Do you have the user pool ready that understands what you're doing to be able to invest in it appropriately?
Yeah, that's a really, really good question, Jay. I think on the asset side, the answer is probably no. However, that's where we eat, sleep, and breathe. So we have a lot of really unfair advantages of bringing assets on. We happen to own 2 large asset pools that have diverse assets across them, and we happen to have existing business relationships with large companies that have tons of assets and who are really interested in this. So if we were starting this just as two guys in a garage who have a pretty good idea and had to go figure all that out, then no, it'd be. But we've already been figuring that part out for years. And I think on the other side of it, in terms of people with liquidity who are looking for yield and storage of value and niche non-correlated returns, I think that side is ready, because there's a lot of, there's obviously a lot of cryptocurrency projects that are trying to do that, and they're getting a lot of attention. So I think we're at a weird space where we happen to have the strange background to bring the side that probably needs a little more coaching, but fortunately we have a lot of momentum there. And then the other side of it, I think, absolutely is ready when they're seeing what kinds of things we're able to do, and able to see it transparently that no, we're not just taking one person's money to give it to the other person and call it a return. We're building something that is, or as I said before, organically, fundamentally stable and growing. And that's actually hard to find, but that's what we've been doing for years.
It's real world cash flows that are enabling that yield that's going out to token holders. And I think that's that in and of itself. And it's not, it's significant yield. I should say it's competitive yield with some of the other protocols in the marketplace that are out there. And so from an attention standpoint, I think like Joel's right. I mean, we're less concerned about the crypto liquidity, where it's really more on the can we get those. Again, this comes back to, do we have the sexy enough assets that gets the crypto liquidity excited? I mean, that's literally what it is. I mean, and kind of planning that launch and planning that positioning is really that's what we need to focus on as kind of the next step. We know we can get the TVL in the 9 figures relatively fast, but is it the kind of TVL that will attract the other side of the marketplace? And look, I've built two-sided marketplaces or been a part of building those two-sided marketplaces before. It's not easy. You got to spin both up, and they both have to reach a critical mass and a virtuous cycle to be able to self-sustain. And that's our goal here.
And just to bring that home and just to make an example of what I'm talking about, the example Raghav gave earlier of somebody who has a fleet of even specific Mercedes Sprinter vans that are generating revenue every month. Well, what he didn't say is we already have a fleet of Mercedes Sprinter vans that are generating revenue every month. We also have fleets of IoT track and trace stuff. We have fleets of screens that are developed. I mean, we have active conversations in the aircraft space. We're already in the luxury vehicle space. So we have a lot of this that we can seed the protocol with. But if we didn't, then maybe we wouldn't be the right guys to build it. But it's because that's exactly the point. Like, is this too early? I think in a lot of cases, yes. But in our case, we happen to be a lot further along and able to at least get to critical mass and get the asset side moving. And the liquidity side, I think, is ready.
But the value comes not from Joel and Raghav and what Joel and Raghav are doing. It's from the adoption that we know that there's asset holders out there who are just looking for this. Right. And those are the discussions that we're most excited about, and the ones that we think will really take this, from 9 figures to 11 figures or 12 figures or whatever that ends up being.
Hey, I'm curious. So how does that onboarding work? So let's say I want to buy a Sprinter van, right? So do I sign a contract with like Dow LLC and then Dow LLC has that like rev share contract, and then Dow LLC funds the Sprinter van, and then if they don't pay, Dow LLC forecloses? Like, can you walk me through, like, because obviously tying a real world asset and a real world cash flow to on chain has always been exceedingly difficult. So how does that actually work out in like a practical sense, especially when it goes wrong, right? Because I'm sure it's going to be some for defaults.
Yeah. So I think you've generally got it right. I think, look, asset owners, they have to submit certain level of minimal information, KYC, whatever, that allows the protocol and users on the other side to get comfortable with, yes, this is real. Yes, they currently have access to this. Historically, this has been proven, and so on and so forth. There's a certain level of, is this going to do what you think it's going to do? Is this asset going to do what you think it's going to do? Component to it, and then once that has been established and proven, there's 2 layers to it. One is just the resilience, or the for lack of a better word, the social proof. Like, is this thing working? And historically, it's not like a Yelp review, but everyone has a rating. Asset 1 performs well. Historically, it's performed well. And so as the users come on board, there's a natural selection that ends up happening with performing assets moving to the top, and non-performing assets or bad actors just dropping off the platform. So I think there's that natural mechanism built in there. But then the protections really are on the contract. Sorry, Joel. Let me just finish this up. But on the contract side, there's the other protections are really, like you said. Look, we'll check UCC filings. We'll make sure that there's from a lien position that the protocol, there's a real world enforcement component that comes in, which will be a combination of like the smart contract being enforced and then using real world court systems to enforce reclamation of assets or whatever we need to do in those situations, right? And none of that stuff needs to be centralized. I mean, there's a lot of that is in fact just, you have very specific parties, debt collection agencies, anyone you want to work with to solve for the bad actor problem and reclaim whatever you can into that back into that ecosystem.
And so if somebody doesn't pay, does the title then default to be owned by the DAO? So let's say I have a Sprinter van, I don't pay, so then the DAO ends up owning a Sprinter van upon foreclosure.
That's right, or the liquidated value.
One one really nice element about this asset class, Stefan, is exactly what you're asking. Is it really lends itself well to small step proof, one slightly larger step, prove it, slightly larger. Because when you're doing assets, it's typically the problem that's being solved in the asset space where you're trying to unleash growth is you have to repeat the same transaction over and over and over and over and over. It's very rarely walking in with a huge lump sum and saying, we're not buying with one check or one transaction. You're not buying the next several years worth of assets. You're buying the next one that has imminent deployment and imminent revenue. And if that works, then you buy the one after that. And then if that works, then you buy the next three. And so you're kind of stepping into, and this is literally how we operate and have been operating. Every transaction we make has more information than the one before it. And so we frequently, even in our legacy business, which is still up and running, by the way, we didn't abandon that to build this. Frequently we say, okay, we would like to buy $10 million worth of your assets. Let's start with a very small amount and show us that it works. And then we'll buy the next amount. And if that works, then we'll start accelerating from there, because it is that element of social proof. And the other thing is, it's so aligned for anybody that has a vision of growth in assets. You just become their biggest hardware customer. And so they're highly incentivized to not be bad actors because they need you there for the next one and the next one and the next one after that. And those are the scenarios that are the best fit when it comes to hardware-based revenues.
Oh, because the person contracting with you is the hardware manufacturer, not the person purchasing the hardware most of the time. And so you have a much larger share of their revenue, and you're way more impactful than like the dude who installs the IoT device in their truck.
In some cases, yeah. And we're always looking at those incentives and always paying very careful attention to that. And that's, but again, the whole point is to decentralize that away. So it's not just Joel and Raghav. It's just we know how it needs to be designed, and we can make it scalable and repeatable where it can rinse and repeat with other parties.
I mean, it's ultimately it's algorithmic and rules based. I mean, that's what we do on a daily basis. So there's no reason why you don't need us, I guess, is the point.
Well, so my question related to that is what is the sweet spot, or kind of maybe the minimum size deal you want to touch? Because I doubt you want, some kid with a lemonade stand to take up your time and go through the audit process and everything else, where at the end of the day, there's no real asset. They may generate revenue. But also in the same sense, are you guys prepared to take on, somebody goes, well, yeah, I'm, we're XYZ airline and we just don't, we're tired of dealing with traditional banks. We've got, $2 billion worth of planes we'd like to do this with. What's kind of the sweet spot for as you ramp up over the next year?
Yeah. So the ramping is always a challenge, right? To give you a sense of when we started our business, we were doing deals in the I would say in the $100,000 range. Over the last couple of years, that's grown to about $5 to $10 million range. And we anticipate that's going to continue to grow. But a lot of that is, like Joel said, initial small purchases, better data, better information, bigger purchases. So even with the example of an airline that wants to offload a bunch of their planes, get some liquidity, and go out and buy a brand new fleet or continue to grow their fleet, it's a similar kind of dynamic. It wouldn't be $2 billion day one. It would be, well, let's buy the first two. Let's see how they perform. Let's prove it out. Let's make sure that it is what it is. And if a pandemic hits and you have to shut down, then right. So it's a proving mechanism, and that those proof points are important for anyone in the protocol, any user in the protocol to see and have transparency into and actually track what that revenue stream looked like. So
are you guys running insurance alongside of this?
Do we run an insurance?
Are you guys insuring any part of the protocol?
We will. We haven't gotten there yet in terms of how and what. I think the idea would be, yes, we would want to, just like we do with our existing business. Right?
It's just too early, but we have explored, creating reinsurance pools and some of those things, and it absolutely lends itself to that eventually. But that's for the DAO to decide. It's not for us to say what the protocol should be doing 3 years from now. And I mean that it's.
But I'd like to challenge. I'm going to challenge that. Like, who the hell are the DAO people? Like, they don't know what you're doing. This isn't their vision. It is. Yeah. And to be clear, the rush in some cases to decentralize, I think, is again that's Web3. But if I'm investing in your your protocol and your team, I want the experts that understand this stuff. The DAO
Look, and
people
then the DAO can
are
make that decision
profit-based.
too, saying, we want you guys making that decision. Go figure out how to do the insurance because you know how to do it. And we
Yeah, I
can't
think,
in that case.
look, it's on the roadmap. Is it prioritized early? No. I think there needs to be a minimum asset pool when it starts to make sense, and a TVL when it starts to make sense, and that's when we'll pick that thread up. I think absolutely. Look, and this is something. This is the classic Joel and Raghav debate internally, which is healthy, which is, hey, I see the ball, I need to hit it. We need to get insurance today. It's like, no, we don't need to. So, but that's a part of the evolution and process of how we want to bring this to life and how we are bringing it to life.
But
yeah,
you bring up
again,
my
question was really related to, again, how are you guys going to interact with this? And really the challenge is, look, there's tons of DAOs and they absolutely push it off there. From my personal perspective, and again, nothing's advice or whatnot. I like teams that are experienced, that know what they're doing. And I think there's absolutely a time and place for DAOs to have governance. But something as integral as that, I would just challenge, is that the right decision for a bunch of people that are interested in one thing only? That's their return.
Yeah, and that's a very, very good point. And what you bring up, whether you meant to or not, is there is a lot of really, really cool stuff you can do with diversified high yielding cash flows. There's a lot of really sexy, in terms of financial engineering, stuff that you can do, everything from securitization to derivative products. I mean, basically, we're talking about a fundamental shift in commodities. If you start financing them differently, there's a lot of bets that can be made in the protocol that we could build out, where you can essentially make a commodity futures transactions market that could very naturally ride alongside the same thing. So should we do them? Yes, do them all, but in which order? I don't know. We have to decide. First, let's get to minimum viable product and make sure the thing works, and then start seeing, okay, what does the market really want? And I think that it's important to acknowledge that we have no idea. We know what the market wants today, and we know what it wanted 10 years ago. But what the decentralized finance market is going to look like in 3 or 4 years, we probably haven't barely conceived of what it's going to be asking for, and what this kind of protocol will be able to enable that we're not thinking about today. To the fact that we have a lot of interesting creativity available, and I think it's just going to be a can of worms if we start talking. And it also
listen, you guys hit
out.
a ton of points, and there was a lot there. Stefan, was there anything we missed?
No, I don't think so. I think my only question was going to be, if it's like algorithmically determined about who's creditworthy, and that algo is public, don't you run into an issue that's going to be super easy to exploit for me to build a technically creditworthy submission because I know what the algo is, and then get passed, and then basically
but it's not. But it's not. I mean, it's algorithm, but there's also verification, right? So audited financials. I mean, yeah, if you can get PwC to sign off on that, then
sure. Okay. So it's more of a traditional underwriting combined with algos to determine which type of assets, but it's more of like a traditional underwriting. Okay. So it's not just like, hey, you sent these 8 documents and we'll send you money type situation.
Yeah. No. It's not like a persona, scan your face kind of. It's the idea is to have that blend of diligence that makes sense.
And we saw that with the PPP loans. If you make something purely algorithmic, anybody can make themselves look any way. You have to have some sort of at least for now, and maybe things will be different. And I mean, maybe with all the total data-driven collection we're going to, there may be a time, and it may be in the relatively near future, where you actually can algorithmically verify down to the truth. But until then, the DAO is going to have to elect, and it's probably going to start with us, people who actually know how to underwrite these and say, wait a second, show me this. Or I'm going to go on site and see it, and I want to see that the vans are actually being built, and I'm going to manually match VIN numbers with the paperwork you gave me. And that's the kind of stuff we do.
There's 80% of what we do, which is, I wouldn't say 80, maybe 70% of what we do is fairly common credit type underwriting. There's a 30% of what we do, which is more the equity style underwriting, right? When VCs look at a deal. And so our process is always a blend of both those. And so the question is, how much of that can you make rules based? And that's really what we're deciding through this.
And so then the DAO basically becomes kind of an agency that does the underwriting on behalf of the investors, right? So it stays decentralized, but just like lots of DAOs hire developers, et cetera. So your DAO would hire underwriters, and they probably start with you, right? But So that's how it would scale up, where you'd have a whole team that
That's
would
right.
verify and vet these deals. Yeah, yeah, okay.
And it doesn't actually need to be us. I mean, it can be us to start off with, but underwriting, there's a lot of underwriting firms out there, a lot of diligence firms out there. And you can just have them on like a rotation, like, on dollar amount or deal count or whatever. It's pretty straightforward.
And Stefan, I want to go back to something that Jay asked of what's the ideal size. I doubt that this protocol is going to be, 50,000 small hardware transactions with 50,000 different users. I think it very naturally, and we're seeing this in our own business, the scale becomes larger and larger, more institutional transactions, because you're solving such valuable problems. And the good news is that's actually easier to underwrite. I'd rather do diligence on 5 deals than 500 deals. And because you can do really good diligence on those 5 deals. And so there's always going to be that argument, but we're not necessarily trying to build a machine that can underwrite anything, anywhere, anytime, anyway, because I think that's very hard to build. And there's a lot of lending platforms that have tried to do that and with, relatively low success in most cases. But to be able to build something that can move, $100 million elegantly with a reasonable amount of cost to it, I think that happens at larger scale. And that's actually where the most interesting hardware problems are.
The reality is it's going to be a vertical based approach. Vehicles, real estate, X, Y, Z asset. I mean, that's how we think about it. It's not, like Joel says, it's not everything under the sun. It's not every single IoT sensor out there.
Sure.
That's awesome, guys. And again, really, it's I always love these when we have like mature teams that understand the asset class, understand the legacy business, and are trying to kind of find a way to merge these two together. And really, really interesting, at this point where you're at, where you still have a lot of these challenges. But again, the asset class changes so often that even if you had made the decision 2 weeks ago, it may change because, now there's more executive orders and things are, in a state of flux. But kind of going forward, what else are you seeing in Web3 that really has got you guys excited that you're, either similar to what you're doing or complementary, or just anything that, NFT projects you think are fun and exciting? Joel, I'll let you go first.
Yeah. I'm seeing one of my favorite, and this is not something that a lot of groups will know. I'm not going to just start name dropping projects because somebody somewhere will criticize anything that I name and it'll make me look like a fool. But one of the things that I've seen are some of the adoptions of aspiring to currencies within ecosystems. For example, we work very closely with an entrepreneur who has an entire ecosystem of vending machines and point of sale equipment deployed globally, but concentrated in Southeast Asia in particular. And when you have both sides of that ecosystem, you can do really interesting currency things in there. And developing that on the blockchain is some of the things we're seeing, like actually solves major banking problems in the when you're talking about an underbanked world or a unreliably banked world. Then you're actually giving portions of society the ability to reliably store and transact value and know that it's going to be there. And it actually removes a big corruption element in some cases. And I love that. I love seeing the technology build fundamentally better systems that are solving real problems. And when it comes to something like finance, decentralized finance is that's such a mind-boggling concept, because finance is, it's ethereal, it's invisible, and it's faith-based. It's like a religion in a lot of ways that everybody kind of has to participate in. Well, when you can decentralize that, then it removes a lot of abuses. And so I really, really like those projects that are trying to build better transaction abilities and trying to build ecosystems that actually operate in the real world and can be applied in systems that desperately need those kinds of systems.
Love it. Raghav?
Yeah, I'll share. There's certain macro trends. I think DeFi has created like this opportunity for payments and payment platforms to be completely Web3 in a way that's never been seen before. There's a couple of protocols that I like. Guys that I've met that I think are smart and doing some pretty interesting stuff. Zebek is one. It's a continuous settlement protocol. There's a couple that kind of have those types of flavors. well-funded, really smart teams that are just changing the dynamics of how money transfers, when it transfers. I mean, simple concept of traditionally, why are people paid on a bi-weekly basis? Well, because they're paying the butt to pay them hourly, right? I mean, and think about the process. I mean, you see this today. I mean, there's issues with how traditional payroll systems work. I mean, so starting with something as simple as that, which is at the heart of almost all creation, like how do I get paid for the work that I do? I think there's opportunities that I'm excited about that I'm seeing in that space that, that are interesting and kind of, I see overlaps with what we're doing as well, right? I mean, there's no reason for people who are within Space Protocol to wait on a monthly basis to collect their invoices and, net 30 terms or net whatever. It's like, no, that device has been out there for the last 30 days. It's been working every single day. Maybe it's 99% downtime. I didn't work for 35 minutes that one particular day. So pay me. Pay as you go. I think blockchain. I think DeFi and blockchain is going to enable some significant, changes as far as that works. Especially, and you combine that with the gig economy and combine that with other, labor and economic trends. I think you end up with some fairly unique opportunities there.
I can absolutely validate that talk. I was speaking to somebody the other day, and he was able to finally basically fill every open position he had with a single change to his ad. And it was, you'll be paid within 48 hours for the work you did. So every other day you're being paid. And I said, well, how much does your payroll department hate you? And he goes, they won't speak to me. But every position's full, every job site is being worked. And so I think it really does speak to that's what people want and almost need, the elimination of the payday loans and these high interest, scalpers. It would be a welcome thing across the globe. And help lift, an entire generation almost out of poverty to get that, reoccurring revenue very quickly and not get into a predatory loan basis. So absolutely love it, guys. It's been fabulous. And so again, I really want to thank both of you guys for coming on. Space Protocol is, I'm excited to see how it continues to go and run out. But again, having true professionals that understand this and understand the regulatory risks, because I like the fact that you at least understand who the SEC is, because sometimes I hear people talking about, well, we're going to do this with the token. And I'm like, well, did you create a security? And they're like,
don't do that. You will go to jail.
Yeah. They're like, what's
First you will pay a fine. And if you argue, then you'll go to jail.
Yeah. You're going there one way or the other. So either document it or not. So that it's, again, absolutely fabulous. Where can people learn more? Where can they reach you and get involved with the project? Or if they've got assets they'd like to get on your get on chain, how can they do so?
Yeah, so our URL is spaceprotocol.io. Check it out. It's up and running. The light paper is on there. We'll be adding some more collateral, and that's where we'll start to see some of the evolutions as it comes along. If you want to reach us, Joel at spaceprotocol.io for Joel, Raghav at spaceprotocol.io, RAGHAV. Look forward to hearing from folks and kind of engaging with this, with the community and people that might want to put assets in here. Awesome,
guys. Thank you so much, Stefan. Enjoy the warm weather in Mexico there, sir. And for everyone else, have a great rest of the day, and we'll see you next time.
Thanks, guys.
Thanks, Jay.